Good morning. I am delighted to welcome you all here this morning to our Learning Community Program. We've got a great group here. Hi, Mike. Didn't say hi to you yet. Great group here and a lot of really useful content that I think you all enjoy. Lots of shareholders around the tables here. I'd like to first thank Brenda for all of her assistance in helping. Yay, Brenda. You see her emails all the time. And I'd like to introduce three of our advisors are here this morning. So Henry, who you'll hear from later, Matt Sullivan, and a brand new one, Joy Sawatsky. You want to raise your hand at the end over there? Looking forward for you to get to know Joy and Joy to you. Also, want to introduce you to Dave and Kathy Peters. You see them here running our equipment. I decided it's really important for us to be taping our events. We use them, just so you know, we use them in our consulting projects and our peer groups as homework, right? Some of you guys know this. So that's really important, and also many of our members can't make it or they're out of state, and then we can use that as a good resource. So I'd like to thank our sponsors. If you could flip that, Mario. Our sponsors make these events possible. We select them very carefully, and also they provide thought leadership. So today we'll be hearing from Mario, one of our sponsors. We also have Kevin Fox here from Capstone. Kevin is in a sibling partnership. And let's see, John Paraka's here from I Am Well. So thank you guys for your sponsorship. Really appreciate that. And just a word, I can go forward. If you have not read the theme book for this year, The Motive, I encourage you to read it. It's a quick fable, and it talks about the why of leadership. Not the how, but the why. And our theme this year is building capacity in the 5 mountains. Why is it important to build capacity? So you guys live in a very complex world. You know this. And so we've created, this is our model, our 5 mountain framework, and it provides a depiction of a framework that helps in some ways simplify what you're dealing with. It provides a common language. And really, if you're doing your work well, and you'll have a chance at sustainability over the generations, you'll be developing these 5 teams or 5 structures, which is what you're all doing. And by the way, you know our philosophy that while we know many family businesses don't make it generation after generation, we often think maybe some of them shouldn't unless there's a shared dream. But the ones that do, this is kind of our model. And I would add, we appreciate having, while many of you have 2 or 3 or 4, you're on 2 or 3 or 4 mountains, we have some here today that are just in one. Where is Kevin? I saw you walking. Kevin Alford? There, Kevin. Okay, so Kevin is a CFO, right? You're not in the family mountain. You don't have some of that other stuff, some of that complexity. So we're pleased you here. Is Dave Budnick, is he here yet? Not yet. Okay, so we have some other CFOs coming as well. All right, so in February, we like to focus, you go back one yet, Mario. We like to focus on different mountains at different times. So in February, we focused on the Blue Mountain. In March, we had our aquarium dinner where the Hershams focused on the Gold and the Red Mountain. Then in April, we talked about scaling up. We had a workshop, that was the Blue Mountain. And last month, we talked about the Family Mountain, talked about family crises and how that impacts all the other mountains as well. Today, we're going to talk about the Gold Mountain. So I'd like Henry to come up. And Henry, can you talk a little bit more about the Gold Mountain and set the stage for today?
Okay, I'm delighted to meet all of you here. We've got people from a variety of companies, all of you who are interested in learning more about these 5 mountains. I just want to note that this is our 30th year of doing this. And Sally Durstein has really been the genius behind this forum. I could never have done this without Sally's good work. And some of you probably understand how complicated this all is, but I certainly really appreciate Sally's good work. And this 5 mountain process is really Sally's brainchild. It is something that I think does help people to simplify what you can't quantify. this is an artificial metaphor, or I don't know, we struggle with how to talk about it, but you know, many of you are completely in all four of them. The advisors wouldn't be, but the rest of you, most of you, are in every single mountain. And how do you tend these mountains over a 20, 30, 40-year period to prepare it for the next generation is one of the things that we think is very important. And these events provide an opportunity for you to kind of stay up to date on some of the latest thinking in each of these mountains. I grew up in a family business, and where we didn't talk much about capital allocation, okay? This is a picture of my grandparents. They grew up on a farm about 3 miles from here. And they had a dairy farm and they got out of it. They went from dairy farming to toilets and sewers. They were plumbers. When I was 5, my father became a second generation sole owner. And I would like us to just briefly, we're small enough that we can do this today. It'll give Mario and I a little bit of a context. So I would like all the people who are in G2 to stand up. Okay, all right, so then how about if we start with you? Why don't you stay up, okay, so that everybody's comfortable. How about if we start with you? Name, company, generation, and how you're feeling today and why you're here.
Keith Riley, G2 Print Mail Solutions, based out of Newtown. Why we're here, well, why I'm here is because I have been going through the challenge of dealing with the shareholders and them wanting money, and I'm trying to keep them from taking the money, and we don't really have a plan around it, so I'd like to...
That means you're president.
I'm trying to figure it out.
Okay, all right, Karen?
Karen Farley, D&K Appliances. Why I'm here is...
Where are you?
D&K Appliances.
Yeah, but what town?
Newtown Square, Pennsylvania.
Okay, in Delaware County? Okay.
Delaware County, and I'm here just to learn and see whatever information I can.
And you have how many partners? How many shareholders?
I have two
Two?
shareholders, and we have 3 generations in the business right now.
Okay.
My father, first generation.
It's a lot of fun, isn't it? Yeah, I met her father a few months ago. Keith, how many shareholders do you have?
1. My father and my mother, too.
Oh, okay, so you're G2 manager, but they're G1 owners?
Yes.
Okay. So they don't quite trust you yet?
I think it's probably mutual.
Hey, that's good. Very good, Keith. We didn't set this up. That's good. Okay, how about you next, Steve?
Steve Cordell, I'm with Cordell and Associates. We manufacture cranes and hoists. We're located in Chalmont, Pennsylvania. We have 2 generations in the business, and I'm here with my wife. She's recently joined us in the business about 6 months ago.
Good.
And we're here just to continue to learn to be a better company.
Yeah, Steve, Steve's father came to us, or you came to us, what, 20, 30 years ago when you were moving from G1 to G2,
Yes.
right?
Yes.
We're glad to have you and Chris here. Welcome. Jason. Sit down after you.
Jason Garman, we're a home builder from Lancaster, Pennsylvania. Garman Builders, we're celebrating our 50th year this year. We started partnering with Delaware Valley a few years ago to help with some partner disputes. Why am I here? We're not a small business anymore, trying to figure out how to get out of the management mountain and do it well and sustain the family relationship as well as continue to grow a company.
So how many partners how many shareholders rather in your company?
So today there's 3 shareholders. One is on their way out. Probably happening this year. That would be me and my brother, and we'll continue to grow. I mean, we've been fairly fast-growing companies. In 2010, we started our growth path about 19% a year. In 2021, we hit a 50% growth, and we're trending about 31% this year on top of that. So until they hiked the interest rate, and, our sales the last 2 months went to 50%.
So a little bit of scale, how many homes you're building this year?
So last year we did 230 homes, we did about $10 million in renovations, for about about $120 million in revenue. This year will probably fall under that revenue number by a little bit, simply because we're not in a land position to build that much product. And we lost, and I talked to some other people here too, we basically lost 2 months of production due to delivery times. So we had to extend our build cycle 2 months, so we lost 2 months of production on top of everything else.
Okay. Welcome to Lauren.
Hi, Lauren.
Oh, hi, Lauren.
Hi.
What generation are you in?
Second.
Second generation. So just tell us, if you could just turn and talk to us.
All right. Well, I apologize for being, I guess, a few minutes late, but I'm
We're
Lauren.
glad you're here.
Thank you. I'm Lauren Miller. I'm originally from Atlanta, Georgia. I'm a second generation management consulting firm. We specialize in inclusive policy initiatives, and we mainly work with the government on the local, state, and federal level.
Okay. And how many shareholders in G2?
4.
4 of you?
Mhm.
And they live everywhere?
Mainly in Atlanta.
Maybe
I'm the
you're,
only person in
you're
this
the
area.
outlier?
Yeah.
Good to have you here.
Thank
Your
you.
first time here.
Thank you.
Glad to have you here. Any other G2ers? Now Sally stood up. She's G2. Mario, you're kind of G2 as well, aren't you?
Kind of.
Jack, and just say a word about who started the firm.
Sure. Kreischer Miller, we're coming up on 50 years. Jack Kreischer founded it, started it, and I started working for him as the 18th employee in 1983. So put it in the category of whether it's better to be lucky or good. So I was lucky. So I got to follow him around for 20 years. He was really entrepreneurial, built the business, and so I learned a lot of what I do today from him. So we have 240 employees now.
How many partners?
22.
Okay, so they all like complexity. Okay, G3 comes in. Who's G3? Okay. All right, well, we'll start over here with you, Rod.
I'm Rod Lefevre. I'm the finance director at Cooper. I am a first-round draft pick.
Yeah.
We have 3 shareholders. We're a farm equipment dealership, 10 stores located pretty much in a circle around the Chesapeake Bay. Sell Case IH and Kubota JCB.
And he has a boat on the Chesapeake.
Have a boat on the Chesapeake, small one.
And why are you here?
Why am I here? We are working hard on what it looks like to go from G3 to G4 and talking about so many different possibilities that makes your head spin. So
Okay.
looking to just learn more and clarify.
Okay, and how many shareholders?
3.
3, and you got spouses who are pretty active as kind of semi-shareholders as well?
The spouses are involved in the family meetings, absolutely.
Yeah, so, okay. Let's go to Jordan next.
My name is Jordan Smucker. I am with Travelers Restaurant Hotel Incorporated. I have 2 partners, both are cousins, and they're brothers themselves. And so we operate a motel and a campground in Lancaster, Pennsylvania. And I'm here, the only one that can make it, but we're here to learn, hopefully to develop more of a long-term strategy for how we direct our profits in the hospitality industry. It can be easy just to go year by year because it changes so fast. But we want to try to develop more of a long-term strategy.
Okay, and tomorrow, my wife and I are staying 3 nights at one of their properties. We have our 54th wedding anniversary, so I'm ready, right? I'm ready to go. David, you want to go next?
Well, David, Catalina, and I kind of, with my brother and I here, I kind of stood up or didn't stand up on G3 because we are G3 of our original company, which is Cumberland Dairy, which was a family-owned business started by our grandfather, and our father, he was an only child, so sort of he was second generation but by himself.
But it's sold, yeah, okay.
And we currently run that operation, but we sold the business to Dairy Farmers of America almost 5 years ago. So we still run the business for them. But it kind of was back and forth because we have a second business called Innovation Foods that we started, my brother and our third brother, as the shareholders are really G1, and we have a G2 that's running that company. And we want to see how to take money out of it as shareholders of it, even though we're not running it, and they are running it, while we're continually managing our
Okay,
whole.
you're kind of the bank and investment.
Yeah, so that's why one foot in sort of each side. And we really don't have it in the dairy side because we're not owners of it anymore, but more management there. So
Uh-huh.
that's where.
Yeah, I'd like to see a few gray hairs here. That's good. So, Carmen, you want to add on to that?
Well, I mean, I think for us, why we're here, is some of what they did. I mean, I was just saying earlier, Brandon, that we had gotten some advice in the late 80s, early 90s. We had participated at the Wharton School Family Business Forum there. And that set us up to move from Dad's generation into ours. And he passed about 10 years ago, and a lot of those things worked out well, at least from the ownership transition to stock in our stock and trust in our generation. But we kind of stagnated there a bit. And now, I was saying earlier, it's a little bit different now, because now we're not signing bank agreements and what have you. We are the investors now. And it's, I hate to say it this way, it's real money now, you know, that we're investing in this next business venture.
Right.
And this is very topical for us right now, because we're building a new facility, and, well, we announced it at 45 million, and it's gonna be a little more than that.
Maybe a little more.
So there's a lot of money going out, and not a lot.
It's always a little more.
So, anyway,
Right, good. Good to have you here. And you're in, where in New Jersey you guys?
we're in southern New Jersey, about halfway between Philly and Atlantic City, near Minot, New Jersey.
Okay,
So a little bit of a schlep for us today, but
yeah,
happy to be here.
really glad to have you here. And, Mike, how about you talk first about LTI and what
Sure.
you guys do?
My name is Mike Miller from Laboratory Testing. I'm here with my cousin Brandon. We're third generation. We transitioned the business from G2 to G3 about 2 years ago. And Brandon can speak more, but we're here really because we have 3 shareholders that work in the business in our generation, and we have 3 shareholders that are not in the business in our generation. And capital allocation it's been, peeking its head above the water, but we haven't had to really deal with it yet. But I think, getting our hands wrapped around this now and figuring out what that strategy or policy looks like is really important for us right now. So,
Okay, Brandon,
Brandon's the president of LTI.
Brandon, you want to add anything?
Not to like hit the nail on the head, I just think the more I learn about capital allocation, the more I understand it's probably one of the most critical decisions we can make as owners and and getting the management team to buy in on, because it can add value or destroy value.
Yeah.
Depending on how you allocate capital. It's just
Okay.
something that we're really intrigued by.
Great, good, really good to have you guys here. These are, I think it's accurate to say that you're the lead shareholders. You represent 2 families, G3 with 2 families, and really a strong, they're doing lots of things right throughout all these families. They've been through more trauma than most families that we've worked with, and they have come out of it smelling like a rose. And they're even making money, right? Okay, good. So Mindy, I'm calling on these 2 last because we are literally in Mindy's backyard.
Yeah, so Mindy Stout, Generation 3. We are CHL Systems, which is actually right across the field here, so we didn't have hard fun this morning. There are 6 shareholders in our business. 4 of us are from G3, so I'm newer to the shareholder pool. So this is an opportunity for us to keep expanding our knowledge base in all these different areas. So, and I do have to put a plug in for Kevin. So Kevin Oliver is our CFO, who
Yes.
Sally pointed out earlier this morning. And he actually was instrumental in engaging with you guys many years before any of the rest of us. And so he introduced us to
Yes,
Kevin.
Kevin.
So it's thanks to Kevin that we have a connection.
Yeah. Can you tell people what you guys do?
Yes, so we design and manufacture custom automation equipment, primarily for the food industry.
Like
So-
what? Give us an example of one of your big projects.
Yeah, so like it would involve conveyance. We're getting more into robotics, pick and place, moving things. It's to go basically going into a manufacturing operation and helping them automate their process, helping them gain better efficiency.
Now, they grew up here in Franconia Township with Moore Packing and and Hatfield
Yeah,
packing, and they take that that knowledge base all over the country. They have an office in Texas.
Yeah, this last year developed an office in Texas.
I mean, they're doing
Expanding our
remarkable
footprint.
stuff, you know, and they're located back here behind the trees.
Yeah.
You don't
Yeah.
really see them.
Yeah, you don't, in the summertime, you don't really know we're there, but we're there.
But they really are doing excellent work. So good to have you here. And finally, Duane, actually, the Berge family shares an interest in this property, right? Somebody. Well, that's right, they're both, they're both first generation owners of this, man. Duane?
Okay, yeah, good morning, everybody. I'm Duane Berge from Berge's. We have auto, truck, and tire dealerships, mostly in southeastern PA, New Jersey, Delaware. We're moving west and north a little bit now. And yeah, we have about 30 shareholders. Why we're here today, or at least why I'm here, is that back in 2017, we had basically 3 voting shareholders, and it was very simple. It wasn't simple, but it was easier to allocate capital. And now we have 30 voting shareholders, and so we're at a spot where we really want to engage our shareholders and actually have them part of the process. What Brandon mentioned is one of the most important decisions, in a given year. So we're just trying to learn, for what we can.
Hey, Kevin, you didn't stand up. You're part of this. Oh, you're G. Oh, that's right. Okay.
He's waiting for the
Thank
next
you.
one.
Thank you. Woo! Okay, anybody here on G4? Anybody here? I can say that now. Oh, very good. All right. Okay, how about we let the ladies go first? These women look younger than they did when we worked with them about 15 years ago, I think. Heidi, want to start?
Heidi Hollinger from B.R. Kreischer & Son. We are from Lancaster, and we do excavating, paving, concrete, so basically site work, anything from the ground down. So we make it look pretty underneath and nobody ever sees it. We are in our 4th generation of ownership. We transitioned from 3 to 4 in 2009, and here we are, looking at what the future's gonna hold with generation 5. So I'll stop there so I don't steal all the thunder.
Okay.
Okay, I guess, well, I'm Courtney Doherty. I'm also 4th generation. Heidi is my cousin, and in 2009, we transitioned from G3 to G4. And I would just like to say Delaware Valley was very instrumental in getting us from that point. And right now, we're looking from 4 to 5. And I would say specific to today, why we're here is capital allocation is always somewhat of a balancing act. So we came today just to get input of how other families are strategizing in regards to that.
Good. Thank you. Kevin.
Kevin Berge from Berge's. As Wayne had said, we have 30 shareholders. So it's we're just trying to learn how, as he said in 2017, it kind of got pushed down from 3 to back then it was probably what, 18, 19, so and now we jumped again. So it just there's when you get all 30 of them in a room, there's a lot of as he said, show me the money. But you got to keep the business going. So yeah, that's
Okay. So Kevin, your great grandfather was the founder.
correct.
What was his name?
Norman.
Norman.
Norman Berge.
Okay. Good to have you here. Thank you for hosting us, guys. I think I get this right, Kevin. Kevin manages 5 dealerships, right?
Yes.
3 in Lansdale, 4 in Lansdale,
Yes.
and then 1 in Wilkes-Barre.
Very.
They've been on an acquisition tear. They've been acquiring a lot of other businesses these days. And these guys have they've got a lot of money going into buying other businesses, and Kevin's one of the important guys to help run. And so we're glad to have you here.
Yeah.
Okay. I said earlier I grew up in the G2, but we didn't have 5 mountains. We only had 2. Guess what they were? Family and management. Okay. So I grew up in Harleysville. My grandparents lived on one side of the shop lane, and we grew up on the other side. There was almost no division between family and business. And we certainly didn't have a board. We had almost no advisors. And we didn't ever talk about shareholdership, okay? But as the business has grown, then there's been more focus on that. Growing up, I heard a lot of words, but I never heard, oh yeah, I grew up with a bunch of plumbers. They have very colorful language, so you can't insult me. Try if you want, but you can't gross me out even, because I grew up with a group who had very broad vocabulary. One of the words I never heard was capital. If you'd asked my dad about capital, he said, you mean Harrisburg? You know, I mean, that's the kind of level of sophistication. Now, we never really had a problem taking profits out. You know, there wasn't that much profit. And if we had profit, you know, we needed to live. And then we buy a new truck. I mean, that was a big deal, right? And then we add on again and again and again, but it wasn't disciplined capital allocation. So now you represent businesses here that have probably have a pretty similar path. And what you've been in the process of doing is developing capacity in each of these mountains. These are really teams, all of which need to be continuously upgraded. And it can be a little weary. Right, Chase? I mean, there's a lot to do. I mean, you know, like sometimes your competitors are just doing this. We're not doing all this other stuff that we think is a good idea. Let's talk a little bit about what do shareholders actually do? What do you think? Why, you know, like in many family businesses, we are really Blue Mountain oriented. I mean, we grew up working over here and we understand it. I mean, like Fergie's, for instance. They know cars. They know how to sell them. They know how to fix them. They know how to market them. Okay? But, you know, like the board is a relatively recent thing. The business is almost 100 years old, right? So you started having a board 2003, 4, somewhere in there.
Ballpark, yeah.
Right? And with one outside director. And then, like 13 years later, a few more. And the shareholder piece was kind of invisible, but now it's becoming much more visible. And we're getting more people. We really know how to do this, but we need to also continue to work on all this stuff. So what do shareholders actually do? This is a pop quiz. We're going to take it at the end again, and we're going to give you a grade. So what do shareholders do?
Elect the board.
Okay, elect the board. Good. Is that in your bylaw? It's in most bylaws, right? Okay, what else do shareholders do? Go on. What do they do?
Fiduciary.
Pardon?
Fiduciary.
Oh, okay. So what does fiduciary mean?
They have a fiscal responsibility.
Okay. So really, this might be the most important mountain. I find it kind of ironic. In many ways, this is the most important mountain, and yet we have the least skill in how to manage it. Because we love doing this stuff. We're really good at this. We're not so good at this. What else?
Well, I would say in our case where we are now, we're funding the business, but it sounds like with some others, there's shareholders that are just, they're looking to get their payments, maybe, and not funding it. Maybe they became shareholders through other ways.
Okay. Often shareholders have to approve by bylaw acquisitions, right? Or you got to approve them.
Depending on the size, yes.
Oh, okay.
Depending on your
So you could manage it and go wild up to a certain point. Yeah. Okay. Well, in our family business, frankly, and I may get in trouble for this, but we did not invest in these things. Okay? When we got to the 4th generation, we were really good at this, but we ran out of town. So the business had to be sold because we didn't keep a balanced process of developing what's required for a multi-generational family business. Now, it has a pretty good outcome because, and I think my grandparents would be very happy with this, because my nephews transitioned the business into an ESOP and immediately merged it with another ESOP that had lots of management talent and knew how to allocate capital. But it's out of the family flow. I don't think that's a tragedy. You know, I think my kids aren't my successors. Sally's my successor. And I think most families really, I don't think have the competence or the commitment to do this long term. You are here because you have that kind of commitment. So next, the shareholders hold primary stewardship. And it's more than fiduciary. I mean, it is fiduciary, right? It is about money. But most family businesses, it's a lot more than money. And many times family businesses sub-optimize the money because the business represents a stewardship of their deepest values. Now the important part, and where this gets complicated, it's even complicated with 2, but when you get to 30, how do you get shareholders to speak with one voice? That's a little bit of a jump. So next slide. When we work with transitions, we spend a lot of time on shareholder development. A lot of transitions happen quickly, and they're driven by the senior generation. They're driven by the senior generation's attorneys, accountants, and all their advisors, and the next generation is kind of the happy recipient of all the responsibility. And we think that's not the best way to make sure that you're developing shareholders who really have one voice and have a commitment. When Mario became a partner in Kreischer Miller, what did you have to do, Mario?
I mortgaged my house and invested the money.
Right. And that's how I started my company, okay? And I think many family businesses owners do not ask enough of their next generation, so they don't understand the pain of capital accumulation and capital use, okay? Now, the things that we work at here are fairly uncommon because most transitions focus on what? Who's going to be president? What the buy-sell is going to look like? What are the other things typically that happen? Often not a lot. And we think it's not near enough. We think it's important to have a shareholder covenant. Now, what in the heck is a shareholder covenant? Sounds kind of biblical, so it's maybe good. But if we go to the next slide, we think it's really important that shareholders have a shared dream. Now, how do you do that with 4 people? How do you do it with 14? How do you do it with 34? The shared dream is a statement about where we're going. And I'm going to show you one from a client, a current client, in a few minutes. But, you know, like if you're going to have a team, you got to know where you're going, right? So then the shareholders need to have a shared dream. Now, we don't call it strategy. It is a kind of maxi strategy, but a statement that says, this is why we are in business together. Now, this is not something that you can have your advisors make up for you. We're working with a client in another state right now where they had a really well-known industry-specific transition group come in and help them with their transition. Well, after a while, they called us and they said, man, this ain't working. And I said, well, what's your shared dream? What? What's your family employment policy, which is, you know, one of the other pieces. Yeah, we have one. I said, well, what is it? Well, I can't find it. And they told me, well, we didn't really write it. Our consultant wrote it. Okay? So the The first thing is the shared dream. Where are we going? Why are we doing this? Are we doing this to make money? How much money? And do you want to make more money than I want to make? Usually somebody is more aggressive, right? I mean, it's hard to get them in a line. The family employment policy is not a family council policy. It is a shareholders policy. In other words, how are we going to, as shareholders, behave so we don't crap in the nest or on each other? Okay, to have that, to talk about it, to discuss it, and agree on it. If you can't agree on it, you probably aren't going to be good partners. Capital allocation, yeah, it's right in the center. This is a seminar on this, so it's right in the center. We'll talk more about what to do with the profits. Okay, already talked about board appointment and evaluation. You have people who take a long time to get an outside board, and then they have them for 15 years and don't turn them over. I mean, come on. The business is changing and your board members aren't. Because we get real nice and friendly and we are now family members, right? I mean, they lose the outside perspective that's very important. So finally, we have a legal agreement. Some people call it a buy-sell. The attorneys call them shareholders agreements. Most people call them buy-sells. And it governs the transfer of shares. Why is that important? Well, for many people, it's really the divorce agreement. It doesn't help you to run the company in unity and clarity. Sometimes it doesn't even help you in the divorce. But these four areas are not. Most families move into shareholdership without these four things defined. Some actually move in without this defined. Now that's getting fairly rare, but earlier, I mean, I've been doing this for 30 years and they said, well, can I see your buy-sell? What's that? But that doesn't happen much anymore. So today we're going to look at, well, I want to say, this is a shared dream that this is actually, I have permission to use this if I don't tell you who it is, because it's in draft form and it's not been approved by their shareholders yet. But it's pretty close. I think it's about 90% there. And their dream is building the kingdom together through diligent stewardship and abundant generosity with God, with what God has entrusted to us. Now, money's in there a little bit, right? Okay, next. And so and there's a much longer document, that we are one team. All 5 of these mountains are working together. And we have one shared dream. Each mountain has an individual specific role and responsibility and rewards. So they're in the process. They are a 4th generation company that are preparing themselves to be really good shareholders. And they've had long and difficult discussions to get there. And now they're preparing their children to be really good stewards. So in terms of, I think that's all I'm going to say, Mario. Capital allocation is really a central part of the shareholder covenant. Your bylaws don't require it, but you should be. I'd like to introduce Mario. Now, we've been doing this for over 32 years, and we've seen a lot of advisors. We've seen good ones, we've seen mediocre ones, and we've seen bad ones. Our partners are good ones. We have vetted them. They not only think they know what they're doing, they actually do know what they're doing in terms of their technical competence, but they also have a commitment and an interest in family firms. And they have experience working with people like you. Kreischer Miller has been a partner of ours for 20 years. But you know, it's good to have a good firm like Kreischer Miller, but you really need a good partner working with you, and Mario has been that for us. Mario grew up in Reading, kind of a hardscrabble town. He grew up in a family business. It was a little grocery store, and I asked him to talk a little bit about this. He grew up in Catholic school, and it didn't screw him up too much. And He actually is an accountant that I like. So we're pleased to work with him and looking forward to your presentation.
Thanks, Henry. Good morning, everybody. It's good to be with you. I'm going to be mindful of time. So the agenda that I'm going to cover, we've got 4 areas. We're going to talk about the issues in capital allocation, what it really means, and I'm going to go through some mechanics. The last bullet here, creating shareholder value, is one of the goals of capital allocation. We may not get to all of that. It gets kind of technical with some finance stuff, and I want to be mindful of time, and we also want to allow some time for questions, right? So the 4th part of this is, I would say, the least important for the group, because there's a lot of conceptual things that I want to cover in the first part of this. Can everybody hear me okay? We good? Okay, great. So capital is an issue for every family company and every private company. So a little bit more about Kreischer Miller and myself, and I'm going to move this clock over here so I can watch it. So we only work with private and family-owned companies. That's all our firm does. We're located in Horsham. As Henry said, we work with Henry and Sally a long time. But our sole focus in life is private and family-held companies. And when people ask me, like, well, how did you get to that point? Well, there's one thing we look at the unique things related to those companies as opposed to the rest of the world with private equity and all that other kind of stuff and public companies. And the big difference is OPM, other people's money. Like, I've done this long enough that I know that when I advise somebody about making an acquisition or buying a big piece of equipment, we all know that there's not a safe in the back room, that if you mess it up, that someone's there to bail you out. So capital in private and family-owned companies is scarce. It's hard to get your hands on, right? I know I'm preaching to the choir. It's expensive, and it takes a long time to develop capital inside a private business because it's on your own nickel. You got to be net of tax. You got to figure out what to leave in and take out. So it is, in my book, the defining characteristic of why we focus on what we do. That right there, that's the issue. If you're at a public company and you do an acquisition, like they've got departments of people that do acquisitions, and you said you do some acquisitions, or Henry may have said that you work on a lot of acquisitions. I'm sorry, what's your name? Kevin. So if you're pick on Verizon, you're the business development guy at Verizon, and you do an acquisition and it goes bad, okay, goes bad. Guy probably loses his job, or gal loses their job, and they go to another business development department, right, at another company. You make a bad decision on an acquisition and overpay, and you don't have a backstop because you don't have access to the public bond market to get 10 years of capital at virtually no cost because you made a mistake. You now are risking all of your many thousands of employees, all your family members, right? You've got a lot more weighing in that decision. That's why this matters. So, knowing that it matters so much, why not be thoughtful, careful, and intentional about what we do with it? This drives me crazy, this last thing. Because I sit with people, we'll go through the end of the year, we'll look at the statements and say, okay, well, we made X. Okay, well, where's the cash? Well, we did this, and it's in inventory, and okay, well, how's your inventory turning? Well, I don't know. And, so we look at the statements, and they had an okay year, but it's like, you work so hard, well, what is the point? And Henry alluded to it earlier, I said, it's better to be lucky than good. I work for the guy who started our business. And when I was, like the 18th employee when I started, I drive our people a little bit crazy now about getting your work finished, getting it billed and collected. Like when I was a brand new guy, because it was all of his money, he said, Mario, job's not done until you collect the money. So I would be doing this accounting work, I'd do the tax work, I'd get the bill done, and then I'd say, hey, and at the end of the year when we didn't have enough money, I would actually go visit people over the holidays to collect the money because we didn't have enough money. The firm was little. But that's my experience in this. And when I was a partner, and I did mortgage my house, we were still a lot smaller than we are today. And if we didn't have enough collections, we didn't pay ourselves. We would not, our discipline is we do not use our line of credit to pay ourselves. So like I got a mortgage, I got all this stuff, and the money's not coming in. It's like, okay, we're not paying ourselves, go get the money. So that's a discipline that I come from. And I'm glad I have it. And so I tried, that's what today's about though. Because I think that everybody knows why this is hard, but not everybody pays enough attention to it. And so that's what we're going to talk about. So people mostly don't understand why it matters. The typical focus of a company is on growth. Tell me if I've got any of this wrong. Growth, profits, how are we doing? Right? Top line. Sure sign to me that there's an issue when I say, hey, how's your year going? Oh, our sales are up X. Okay, well, I want to know what's happening in cash flow. How much are we growing our net? I don't care at Kreischer Miller about our sales. I want to know, I don't want to know what we're getting. I want to know what we're keeping, right? Because that's the only thing you can use. So capital allocation is one of the most important things, but most people are not aware of how important. Now, hopefully I'm going to show you why and give you a couple tools. People focus on growth, but the allocation of the capital you have is probably the biggest issue with future growth. Everybody's focused on growth. P&L, we need more sales, we need more profits. But what you do with last year's profits and how you reinvest them is like one of the biggest predictor about what that growth is going to look like in 5 years. But we don't pay attention to it. If we're thoughtful about how we do that, that future growth can be amplified because we give it proper attention. Item 3. Most of my experience is most people focus on the P&L versus the balance sheet. Show of hands of anybody that focuses on the balance sheet more than the P&L in your business. 1, 2, good. Hey, you guys are ahead of the curve. Most are focusing on the P&L, which is really important, right? Got to have a profit, margins, all that other stuff. The balance sheet and how it integrates with the P&L is really, really critical. And I'm not talking about accounting. It's got to balance all that. You know, one of the things, maybe this is why Henry likes me being an accountant, is that when I look at a set of financial statements, I don't care about whether the accounting's right. I care about what it tells me. I've trained myself at this point to look at it and say, you know, I can look at the P&L and the balance sheet, and I don't, it doesn't bother me so much as to whether it's perfectly done in accordance with GAAP and all. I don't really focus on that. But I can tell pretty quickly what it tells me about the business. And that's what the balance sheet, why it's so important, because the way that it integrates with the P&L and what you do with the profits and reinvest it is a huge deal. And lastly, like it or not, your capital is allocated every year. Every year, every month, every day, the capital that gets earned in your business is allocated. Got to go somewhere. Question is, are you intentional about what you decide to do with it? And you've got a lot of choices because there's a lot of things that drive that decision. So I found this online. I thought it was this is relatively simple, but it's not simplistic. There aren't 48 choices here about what to do with the profits of a business. There's a handful, which we're going to talk about. And here, you know, share buybacks, dividends, piled up on the balance sheet, acquisitions, plowed back into the business for growth. There's a couple more categories, but broadly those are it, and it looks kind of simple. And it is in that respect, but how you execute against that is not simple. So we're going to talk more about that. So somebody stole my thunder, said it's a balancing act. I forget who it was when we were doing your introductions. It really is, and this is why it's so hard. So competing priorities and unlimited choices are the characteristics of what you can do with your capital. So that requires trade-offs. So a story, one of my favorite stories about trade-offs and capital. Now you wouldn't think that Apple has limitations on its use of capital, but back in 2004-ish, You know, that's a time after Steve Jobs sort of came back. They were getting their act back together. They had gone through a very bad period. They actually had developed the iPad before the iPhone. They had that put together, and that device was ready to go. And the iPhone was several years behind it because it was smaller, but basically the same device, but, you know, like, I don't know, an eighth of the size. And so they had that ready to go. It was ready to go, but they had to make a choice because they had limitations on how much they could spend on marketing, all this other stuff. And they decided to shelve that for 4 years and introduce the iPhone first because the market size of the opportunity was so much greater with phones than with the tablet, even though, plus, if they released the tablet, they were going to release their technology, which is basically the same touchscreen technology that was on their phone. So they had to make a choice. They had to make it, there's a trade-off there. They deferred some growth for the sake of the better opportunity. In our business, in your business, again, you've got capital sitting in the middle of this. Scarce, limited supply, and it's expensive. It's hard to get. You know, by the way, the whole issue of other people's money, how many of you, when you think about needing capital, are anxious to go to an investment type firm to become a limited partner in your company, like a minority partner, a private equity, or I see a little menza, I see a lot of head shaking no. Usually it's not, because you give up your autonomy, you give up board seats, you give up, you know, sort of your cultural part. You know, like, it's got to be a serious reason why you'd want somebody else's capital to let somebody come into your business. By the way, if I'm standing in the way too much, just wave me over. You know, to take somebody's money, there's a lot of strings that come with it. So generally, that's not a source. So the priorities, though, are, as Henry said, the family's shared dream and values. Like, that really has to come first in a family company when you think about what to do with the capital, because there's often a bigger purpose to the company. If you were a public company, family values and all isn't really high on the list. It's all about, you know, shareholder value creation at a public company. But for a family company, you've got three competing things, or three things that weigh into this. One is, what is important to the shareholders? When you think about what you do with your profits, you know, like, what do you want to do? I have some clients who support the Boy Scouts. I have some clients who allocate towards their, you know, religious area. I have others that do community reinvestment. I have somebody who invests heavily in employee ownership initiatives and funds research and all that sort of stuff. Like, you know, everybody's got their own thing, but for a family company, that's usually one of the first allocations is, look, what is important to us? Secondly, when you think about allocations, you've got to make sure that you're clear on your strategy. Like, what, you know, this is about what the shareholders want to do and what's important to them. This is what you're going to do with a company. If you have a strategy of growth or whatever it is, you know, you better be clear on that when it comes to allocating the capital. Because you have to make choices. You can't do everything you want. So you have to be thoughtful about the company strategy in lieu of, you know, sort of this first thing about what the shareholders want. And then lastly, there should be shareholder value creation. After all, why are we doing this? Now, value creation can mean different things to different people. You know, value is created by, you know, giving value to others, if that's important to you. It's also created by the value of the business. It can also be created by taking money out of the business, distributions, getting, you know, wealth distributions. Value can be determined in many ways, but certainly at a high level, creating value in the business one way or another should be a goal. Because if you're not creating value, right, things are maybe going the other way. And by the way, if you're creating value, in the worst case, maybe you don't want to harvest the value, but it gives the business the better opportunity to achieve its objectives going forward. You have a better business to hand over to the next generation, right? A healthier business. So those are the three things that matter, but you're dealing with, you know, what are the priorities? What choices do you want to make among them? And what trade-offs are you willing to make? Because you don't have the ability to do everything. It's limited. and it's expensive to get more of it. So you better be thoughtful about how you're going to allocate the capital, and when you decide to borrow, you got to be thoughtful, right? When you use leverage to achieve objectives, which can be a really good thing, but it can be bad if you have too much of it. So you got to be thoughtful about it. So it's the intentional decision. This is, by the way, I didn't, look this up anywhere. This is me, the way I talk to people about it. It's an intentional decision about how to best utilize the company's resources, its existing capital and its profits. Okay? Go through it again. Intentional, meaning you should have a plan. Now, if you had a plan at the beginning of the year of what you wanted to do, by the way, these slides are in your folder. If you have a plan at the beginning of the year, does it mean that, when you get to the end of the year, it's going to line up exactly? No. But it is at least a footprint that says, look, this is where we're headed. This is what our expectation is. You have, and I'll show you a very straightforward model that we use. We have some more sophisticated tools, but I'll show you a basic one. Now, when I say existing capital and profits, part of capital allocation is what to do with the profits you earn each year, but it's also what to do with the capital that you have. Because you have that thing on your balance sheet called stockholders' equity, that's your capital. What's the best use of it? If you've got a really important long-term project, you can use that capital base to lever it, right? If you've got a big project that's important, you have to think about how to best utilize the resources under your control already, and there's times when you lever that capital. In fact, I'm working on something right now with Henry and Sally, actually, where it's a very long-term situation. Company is very firm balance sheet. It's not over-levered, and there's room to, if they want to do some growth stuff, that they can use their existing, particularly when cost of debt is reasonably cheap, and we can get it for long periods of time. Levering that capital base isn't a bad thing. Again, too much leverage isn't good, but there's ways to monitor that, right? So it's both of those things. And as I said, achieving the shareholder objectives, supporting your strategy, and creating economic value for the shareholders in whatever that means. Could be dividends. By the way, another element of that shareholder value could be, particularly in companies where you have passive and active shareholders, providing a mechanism where a passive could put their shares to get redeemed. If they're not, if they're not in the business but they've received shares, maybe it's best for them to, they may want to be cashed out of those shares. That might be a good thing at the family level, and there's ways to, blend that into your strategy in terms of allocating capital towards it. So those are generally the three areas. So on the family side of this, it's a little bit of a repeat from what Henry said, but what do you value as the shareholders? What's important to you? Why does the business exist? What's your purpose? What are goals that are important at the shareholder level? And our priorities from a governance standpoint. So to me, I use the word governance here, but I've adapted this with Henry and Sally's language with the shared dream and values, so we're consistent. But common objectives are taking care of our people, community support of some kind, charitable giving, and then the last two, again, as part of the governance, what do we want to do to return capital to the family in the way of a dividend policy or a redemption policy? So when you think about allocating capital, like I've got some companies that say, look, when we start doing this, first things first, this is important to us. We're peeling off the first X% for these two priorities. And that's it. Mario, you can help us figure the rest of it out, but this matters to us. We're doing this first. I have people who do that, not everyone. So with many families, there's things that are just, this is why we're here, this is important, why we're doing it. Strategy choices. huge issue when you think about what to do with your capital. So I'll give some examples here. Grow the company. The first three are kind of the growth thing, right? Expand geography, product lines. Well, if you're going to do that, you need capital to do it. So if, as opposed to number 6, we're going to harvest capital. Listen, we're comfortable at the run rate we're at. We're not after a 10% growth. We're going to grow with inflation. We've got this business lined up. We know what we do well. And we're happy with what it's doing. You know what? It's going to peel off X% in the form of cash flow, and we're taking it out. And we'll leave enough in there. That's completely fine if that's what's important to you. Not everybody needs to show up every day needing to grow 40% or whatever your goals are. You can do whatever you want. But the important thing is decide what it is you're after. Are you at the point where number 6 is important to you, or you're trying to grow and expand? So and by the way, strategy is not the annual operating plan. Those are important. This is what we think is going to happen. That is not your strategy. Strategy is, what business are we in? What are we going to do with it? How are we going to grow it or not? Are we happy with where we are? What choices are we willing to make? Sacrifices are we willing to make from A to B? It's not only assessing competition, it's assessing risk, right? And making all those decisions about what the picture looks like for this company in 5 years or in 10 years. That's your strategy. It's not what happens in the next 12 months. That's maybe a manifestation of it, and certainly that's an operating plan. So other things, preparing for a sale. I've had people come to me and say, look, we want to get out of this business. So in fact, I'm working on something right now. We want to get out of this in 5 years. Help us allocate capital. Well, guess what? We're not buying big equipment that have a payback of 8 years. Not happening. We're going to fix what we have. We're going to use what we have. We're going to maximize the cash flows because this person wants to get out. So those are different choices. In fact, the first conversation with this person was they had an issue in their plant and they were thinking about spending a lot of money to buy a new building because they had like an issue with water and complicated thing. And this person was thinking, hey, I need to get out of this plan. I'm like, whoa, wait a minute. How much are you going to spend? X. Time out. We have to look at alternatives. That is not going to be good if you do want to get out of that business in 5 years. You need to borrow money, which means that when you sell it, you're paying that debt back out of your pocket. So again, that is an example of, if you know your strategy, how you would direct your capital. And the last one, and this is the part we probably won't get to today, is the whole idea about creating shareholder value. But I'm going to give you a basic concept of it, because this has to do with, this is more of the geeky finance part of this, but it's really important when you assess an acquisition, optimization of utilization of your assets is a big deal. Working capital, asset turnover, when you do an acquisition, what's our hurdle rate on that acquisition? Are we going to, when we buy it, what's our expectation of what the payback period is? Like, you don't need to get too complicated, but when you do an acquisition or you buy a large piece of equipment, what's the payback period on that? Is it sensible given the risk you take? So you got to be smart when you deploy capital towards things about getting rates of return that are going to make the value of the company greater. So there's some mechanics involved here with finance. And then secondly, using leverage well. I mentioned this earlier, but you got to be smart about it. The company that I'm working with Henry and Sally on had no debt, but they're looking at very large scale, longer term stuff. And we just said, look, why take this all out of your working capital? You can borrow long at X rates. Why not? And without, risking the farm to do it, like a reasonable borrowing that supports a long-term strategy instead of taking all your cash out to buy some of these assets you need to expand. So debt isn't I'm not telling you that everybody should lever up their business, but the right amount of debt can be very useful. depending on the strategy you're pursuing. And lastly, the return to the shareholders we already talked about. So this guy's the master of capital allocation. Somebody I've followed Berkshire, and this guy, I've read everything that they've ever written since 1992. I am a huge fan of the way they operate their business, even though it's not a private business. They run it like a family company pretty much. If you want to read their operating principles, they're online. It's if you said, look, I don't want to read any business books ever, I just want to read one thing, I would read what this guy writes. But he's one of the most successful capital allocators, and people don't know this about Berkshire Hathaway, but he doesn't run any businesses. They make acquisitions, the businesses are run, and all he does is allocate the profits. In fact, Berkshire Hathaway was a knitting mill that was heading off the shelf when he bought it. He bought it because it was cheap. And they made hosiery and linings for men's suits in New England textile mill, and it was at a time where all that business was going to Mexico. And he bought the stock because it was cheap, and he didn't know that he got a horrible business. So he ended up hanging on to it, and for 15 years let it operate. But every year the managers at that place, with shrinking sales, shrinking margins, in a business that was being completely disrupted, wanted him to, hey, we need new equipment, we need to reinvest in the mill. He put nothing into it. Made him go back and use what they had, but every bit of cash that came out of that, he used to buy all those other businesses. He didn't reinvest in the business because that shareholder value thing, the return on that invested capital was really bad. So he allocated it to other things. So this book is a good book if you want to read something, called The Outsiders. And we're going to take a quick time out because I brought one. So anybody who first can tell me Warren Buffett's age can have the book. 91. 92 was close right out of the gate. Anyway, this is a really good book. It profiles him and some other CEOs that all they basically concentrate on is allocating capital as opposed to operating the business. So, capital allocation is sort of the intersection between the income statement and the balance sheet. Here's where the statements connect if you want to think about it intuitively. You don't need to be an accountant, finance person to kind of understand this. This is where the capital is created, right? And look, we all know we got to be good at this. We got to pay attention to margins and growth and all that stuff. I'm not saying that that isn't, arguably more important or just as important. But this is where the capital gets created, right? The balance sheet is how you utilize it, how you deploy it. And so the intersection is here with these. These are the three things you're solving for: family values, the strategy, and creating shareholder value. And you've got these things that are the constraints. You've got to make choices. You've got to make trade-offs. So it sits in between the two of where the money comes from and what you do with it. So this is my favorite slide in the deck. And this is my way of trying to give you, particularly those of you that aren't finance people, a basic way to think about the way your financial statements work together, because they really do. So the assets of a business are the engine of the business. They're the engine. You can't generate a nickel of revenues if you don't have assets. What's the first thing you do when you start a business? Suppose you start a business from scratch and you go put $100,000 of your savings in. What's the first thing you do? You buy whatever you need to buy in order to give yourself the ability to operate to generate revenues. So the assets of the business are like the engine. If you don't take care of the engine and you don't make sure it's efficient, eventually what happens? Got all the Bergie people here, the car people and truck people, right? The thing runs out, it wears out. If you don't change the oil, if you don't make sure that you're investing in it, you're taking care of it, it's efficiently being run. So the assets of the business are what you need to produce revenues. That's the purpose of having a pool of assets. The cash flow is the fuel, right? You start, this is like a virtuous cycle. You start with that 100,000, you buy $100,000 of assets, it generates a certain amount of revenue. Revenue turns into profits. Profits get reinvested, or you could take them out. You could, but let's just say we wanted to grow. You take the profits of $10,000 and you reinvest them. Now your asset pool and your equity is 110 instead of 100. Well, now you've got more capacity of assets to drive more revenues. Next year, profits are 20. You reinvest those. Remember when I said earlier it takes a long time to create capital in private businesses? That's what's happening. This cycle is why it takes long. Because none of us want to take other people's money and because we've got to put up with them telling us what to do. Your mix of equity and debt are the controls. That's where you need a really good financial officer or a good advisor to help you decide, right? Because let's use my example. Suppose we got to 130,000 after the third year. When you think about the 100 you put in and you made 30, 10, and 20, we're 130 now of equity in this business that we have now on our balance sheet. And now we got a great opportunity. We got no debt. Well, maybe we should borrow 50. Because we now, instead of waiting for that next year's of profits, another 20, we borrow 50, we can get this new machine or whatever it is. Now our asset pool goes from, instead of being 130, it goes to 200 because we could borrow 50 to get our hands on this new machine or whatever it is we need. We need another plan or capacity. Now, we can throw more revenues at it beyond just what our company earns. So the way that you manage the lower half here, this is like the controls, the steering wheel. This is the decision about whether to take money out or leave it in, or whether to lever the capital we have. Those are management decisions. And they're finance decisions that you can quantify with the right analysis. Everybody with me? It's like my favorite slide because it's a non-financial person's understanding of the way these statements work together. But that's really what it is. You need assets to drive revenues. Revenues drive cash. Cash gets reinvested. And then the shareholder's job is to pull those controls. Sure, when you make acquisitions, okay, what do we borrow versus what capital we put into them? What makes sense? How much leverage is too much leverage? So, capital allocation is the meeting of the balance sheet and the P&L. So what do we do with those profits? So they get absorbed. How much cash are we shooting for to have as a result of this exercise? How about working capital, investments, acquisitions, property and equipment? So when you make these decisions, you have to develop tools and analysis to determine how you're going to do it. If you're going to make an acquisition, I'm sure you guys, because you do it a lot, you've got a lot of metrics and things that you work off of as to whether to make the investment and at what price. These guys probably have forgotten more about how to value a car dealership than I would ever know, because you do it a lot. So they have metrics, they understand. So when you make a large purchase of property, plant, and equipment, and let's think about the difference between certain amount of capital expenditures are maintenance, things just wear out. But how about the idea of, hey, we want to buy this new machine because we want to expand our product line. Okay, great. Let's see the math. What's it going to cost? What incremental revenues are we going to get in profits? What's the payback period? What's the internal rate of return on that investment? And does it make sense given our capital structure and our return requirements? Most of the investments here, plant and equipment and acquisitions and so forth, you have to have ROI models to evaluate them. Not everything. As I said, there's certain things, if you have a plant where things wear out. Our big expenditure is computers. We don't have a factory. Our factory is a bunch of people working. So we know what the replacement cycle is. We don't do a big analysis of replacing our laptops. But if you're thinking about a new plan expansion or something, you better have a really good, clear picture of how you're going to get a return on that investment, and you need metrics around that. And the board's job, the family's job, is to require it of the managers. That's the separation of the mountains. The family owner's job and the board's job is to say, look, we need to see the justification of all this stuff before we allocate capital to it. Or we're not doing it if it doesn't make sense. If we had more time, I could give you unbelievable stories of cases that I've seen where people just sort of went off the rails and risked large amounts of money. I have cases where companies had to be sold because of it, by being reckless without having a process between the family, the board, and the managers about larger expenditures for an acquisition or a large capital project. You have to have discipline around those things. So here, what do we need to commit to pay back debt and working capital? By the way, just quickly on working capital, you have to have metrics and standards in your company about working capital turnover. You don't need to know how to calculate it. You've got financial people who know how to calculate it. It is like, the place where money gets lost in working capital. And your working capital, if your sales are growing 2% and your working capital grew by 22%, you've got a basic problem. Things aren't turning over fast enough. You've got an inventory purchase problem, or you've got a billing problem, or a collection problem. So working capital is like the land of the lost from capital allocation, and people don't pay enough attention to it because it just kind of happens. It's a process thing. So my advice there, it's a different analysis than making a big acquisition. It's day to day. I want to see the working capital turnover by product line. I want to see, details of the receivables. Like the best operators that I have among my clients, and I've got some people who are just off the shelf great operators, are on that every day. Every day they're watching the inventory and the receivables every day. And then lastly, again, as we talked about, allocations for redemptions, distributions, and what we're going to retain. So this will be the last section. I'm not going to get to that financial part because we want to allow time at the end, I believe, right? So I'm just going to show you a very simple, there's way more sophisticated stuff you can do here, but a very simple way to think about this. So this is a 2-page model that just shows, and the value of this is to say, most people say, okay, well, what do we want to do with Project X? Well, we made X dollars last year. We've got plenty, we should be good. But I'll show you how once you get through the various categories here, you may have less than you think. So being able at least to put this into categories and understand what resources you really have at your disposal is probably the most important element of an exercise like this. But this starts with operating income. Fictitious company has $10 million. And in this case, number one here, there's a profit sharing program of 18% of the profits. I'm not telling you should have 18. I'm not telling you should have 8. We've got people that do this differently. Not uncommon for the best companies that I work with that they're giving, they're sharing with a team either a gain sharing program or something. So in this case, I used 18%. So on a $10 million pre-tax number, we've got $1.8 million coming out. And then in this case, there's a charity community component. That's a family policy thing. That's another 10%. So now that's $1 million. So at that point, both of those items are tax deductible, right? So now we have to deal with the government share that they get. So 7.2 million's left. I used a 33% tax rate, assuming it's an S Corp in Pennsylvania. And of course, we have depreciation on the P&L. That's an add back, right? That's a non-cash item. So you can see quickly that we started at 10 and we got to 60% of that pretty quickly by dealing with taxes and by addressing that family values piece. So you could make a bad decision if you think you're dealing with 10 million when you start to think about the rest of what you want to do, because that's not the case. It's got to be net of tax and net of other commitments that are important to the family. And again, these are examples. This is not a standard thing. Everybody does this differently, but you can see, by the way, I like to describe things in a per dollar. If I had a dollar of income, I now have 60 cents of that dollar left over before I now think about what else I'm committed to on the debt side or reinvestments and so forth. So now we have company reinvestment, working capital growth, maintenance CapEx, which typically I don't suggest to people that they borrow for. In my book, that's just like an operating expense. If it were up to me, by the way, I don't think that all the accounting rules are right. They're very wrong economically, many of them. So a lot of my colleagues, I get into arguments about that, but I don't think that they're economically reasonable. Maintenance CapEx in my book is an expense. And that's why I don't suggest people borrow for it. So I assumed $1,600,000 of working capital because the company's growing. And by the way, if we had time, I could show you how to calculate that based on your current working capital and growth rates and stuff. So if anybody wants to learn more about that, I can talk to you offline. But I assumed there was $1.5 million of maintenance CapEx. I have a category for growth CapEx, net of borrowing, if you decide you want to borrow. And then the last category is an acquisition, net of borrowing. And I just assumed that there was an acquisition of 1.5, and I assumed that they didn't want to borrow for it. But we could have borrowed, some or all of that. So after we reinvest in a company, $3.6 million, that's another 36 cents of our dollar. 36% comes off. We've got some debt to pay back, principal and interest. We get a tax benefit of the interest because it's deductible. So when it comes to third-party commitments, that's another 9% of our $10 million. And then we have shareholder commitments. So we have some redemptions in place that we've allowed, and we have a dividend policy of 5% in this example. So the shareholder, debt repayments net of tax, and the dividend commitment's another $900,000. So on $10 million, we actually have $589,000 left over after meeting all these commitments. Now, the reason I think this is important is to model this out so you at least have a gauge of what you think you're going to do about at least you can say, you know what? For instance, this might be variable. This dividend usually is variable, right? That's usually only paid if we have the money. But this is a commitment, right? The redemption debt is a commitment. The bank debt's a commitment. This is a choice. That's probably not a choice. And the maintenance CapEx are not a choice. So you could start by just looking at this and saying, look, this is modeling out what we have and what we're committed to. Now let's fill in the gaps to the part where we got to make some decisions. And if you don't have enough left over, here was where I might borrow some money for the acquisition instead of peeling off all the cash. You with me? So it's a basic way to look at it, there's other ways that I have this modeled. Henry has seen it and Sally, where you say, okay, here's the committed amounts and here's the uncommitted amounts. So you can see how much of that dollar, we are dealing with before we start to make adjustments and pull those other levers to borrow or not. I'm going to stop here because the rest is, and anybody that would like to talk about the rest of this, which was more of the finance part of shareholder value and how that works, I'd be happy to go through it with you. I think my contact information's on the slides. Call me, we can set up a Teams call or whatever, and I'll walk you through it, but it's more finance technical stuff. But anyway,
thank you,
good
Mario.
to be with you, and thanks.
Questions, and Mario, stay up
Okay.
here. We want you to, questions or comments that you have about capital allocation. Well, I have one. Go ahead, Dave. Carmen.
So, Carmen, Carolina. So, question that I would have is, I think we sort of got religion towards the end of our ownership of the original business. Because someone said to us, well, you guys are in a lifestyle business. You like the lifestyle. The business is funding some of that. But you're not thinking like you're going to sell it. So I guess there's lots of different metrics you can use.
Mm-hmm.
But towards the end, when companies had expressed an interest in our business, focused our attention on the EBITDA numbers and things of that nature. What's your thought process on that being a target or the target?
Yeah, so, and I have actually slides on it, and I've done presentations about it. I think you got great advice. And I'll give you my view is, first of all, there are a lot of lifestyle businesses out there. I can see them a mile away. I can look at those financial statements in about 2 minutes, and I can tell you kind of what's happening. My view is that when you look at the performance of the business, you should have the right operating metrics, the comparisons, all that other stuff, and you should run it like you're going to sell it. Whether you choose to or not, you should run it to optimize it. And that means having good incentives programs with your people, accountability of the managers, all that other stuff, board accountability, all that stuff. Run it like you're going to sell it, even though you may choose to do that or not, because if you run it that way, like a third-party investor would, so I see a lot of private equity people, and a lot of what they do I don't like, but there is a lot of what they do that's really right. They focus on return on invested capital, which is this last part. So what I tell people is run the business like you're planning to sell it, and if you choose not to, so what's the worst case? You got way more cash flows to reinvest or take out. You've got a better business to hand over to your kids because it's running better. So to me, that gives you the most optionality. And that is, to me, the key. So running it like that way the whole time, by the way, in lieu of the things that are important to you. I'll give another quick example. I have another client I work with, and they tithe. And we're working on some acquisitions. And I got into an argument with them about it. Not a bad argument, a debate. Like, look, we're trying to optimize here because you're going to need this money. You can tithe more if we have more to put down on this acquisition than taking it out now. So that was a really good debate. I lost because it's their business, but that's completely fine. The point, though, is that you got great advice, and I think that advice is what everybody should use. So that's what I counsel people to do no matter what, is to work at making the business the most valuable asset that you can.
One other thing I'll just add is, remember YPO, one of my YPO friends said to me, I don't get you family business guys. He said, I've started 3 different businesses, sold 2 of them, and I was going to sell them from the time I started them. So it's just, some of it too, I think, is how you enter the business entity and where that may take you.
Pete? Wanted to know if you could share some best practices on how you would manage allocations around working capital growth, maintenance CapEx, and growth CapEx. At my company, it's this fluid thing. So we have a forecast, we have our strategic plan, it's just fluid, like whatever's bubbling to the top, I run it through the forecast, and then we make a decision. It feels very haphazard. So just curious, what are like best in class companies that you're seeing doing around CapEx and like should that be more organized?
Yeah. Well, the maintenance CapEx piece, what I see the best is that there's a capital budget every year that's based on normal business operations and the need to replace things that are wearing out. So that's part of the annual operating plan discussion, and it's part of, people saying we have it all the time. And typically, like ours, again, is a lot of technology stuff.
Is that just sort of haphazardly bubbling up the planning process?
No, it's not. It's the way it works, at least for us and a lot of companies, is there's going to be an ask. You go to the manager and say, look, what do you need? And then when it comes time to putting the budget together, you whittle through that and say, okay, what's a like to have, a must have, and you try to be efficient with those requests. But and then what doesn't come in this year stays on the list and revisit next. So there's a process around it. The other CapEx for growth, there has to be a process of calculating the internal rate of return or the payback or some basis to say, look, if we outlay this money, what is the expectation, not of revenues, but of net cash after tax from this investment, and does it make sense to do? or is it best not to? Because we're not earning a return on our capital that is worth doing, or is there another alternative? That part of it is like a separate analysis of, you have to have Jim do an analysis of the ROIs on those kinds of things that are unique, that are growth oriented. It's to me a different conversation.
Policies on CapEx.
Pardon?
Do you ever see companies having, or shareholders having policy, like we will reinvest X into maintenance, we will invest Y into growth?
No, it's not so much a policy thing, because the maintenance stuff is there no matter what. It's a question of evaluating it every year and saying, okay, what is really necessary to spend or not? Because you want to, from a utilization standpoint, you want your asset turnover to be high. So you want to reinvest in it only when you really have to. So that's more of like, look, are we getting the best utilization out of those assets? The growth part of it the growth part of it means it's going to get you into a new market or a new business. That is a finance study, like you would do an acquisition of a business. What are the future cash flows? How much are we going to invest? And does it make sense? If the payback is 11 years, probably not a great idea. Payback's 4 years, 3 years on a CapEx project, that starts to sound more reasonable, but you can develop metrics around it.
So, some of this may be practice, like one of the boards that Mario and I are on, 4 million is kind of, don't go above that. It's not a policy, it's not written. It's kind of a practice that, yeah, you're gonna have to reinvest, make proposals to us. And I think the board's getting better now at doing that. I mean, this is a long-term process of your CEO and your CFO doing their work, and then the shareholders kind of giving a beginning direction about what they want, and then your board kind of mediating between the two. I mean, you're president, right? You're going to want to spend it, right? Most presidents we want to grow, right? And so the shareholders are kind of a break on that, but they have to decide. But in some companies, I talked recently to a shareholder who was talking to the CFO about capital allocation, and he said, well, no, that's not your job. I do it. I'm CFO. Now, we don't agree with that, okay? A capital allocation is really a conversation between these three mountains. But where does the buck stop? Where should the buck stop? Here. Right. But there's a constant negotiation back and forth here. You don't want your shareholders to be nuts. Like we want to take out 50% or 80%. Some companies we work with, they take all the cash out. Others take none.
And by the way, if you're a shareholder, there's a trade-off, right? If you have a policy that says, hey, we want to give ourselves big dividends, you can take that money and you can invest it yourself. Or do you think that it's better to leave more in because the opportunities in the business to grow your value are that much better? Like remember those levers in the equity and the debt section, and that's like whether we borrow more or whether we take out money. You're making a decision if it were me as the owner, okay, do we leave in or take out? Because both of those things are important to me in terms of value. I can take that capital and reinvest it with my advisor, my investment advisor, or I can leave it in and keep, let the value of the company continue. As I said, I have way other elements to this but like you should have a valuation formula for the business so that you're tracking how much value is being created, without somebody else telling you, within reason.
Brandon?
Can you talk about how you can start these conversations with their management team and how to get the managers on board with this type of planning and discussion, and like how that translates into value creation?
Yeah, I think part of it first is, I think some broader education, maybe a little more in depth on this. Most people don't understand this.
Shareholders or managers.
Right. They don't they kind of know the balance sheet thing. It's accounting stuff. It's a little fuzzy. This most people understand. Okay, you got $1 of income and pay expenses, although we all know there's a lot of dynamics of how you get from top to bottom, but they're not financial people. But if you begin with an understanding of the fact that basically the way that the game works is when you use the fuel here, what you're trying to do is to get the highest velocity of dollar of sales for every dollar of asset. It's in the end part of my slide today that we're not going to be able to get to, but asset utilization is what this is about. You want to, if you have a dollar of assets, if you have $4 of sales generating off the dollar of assets, if you can get that to $5 without, that's where the game is won and lost, because you're expending less resources to generate more sales. Now, if you put another dollar into assets and you can drive $1 or $2 more of sales because of it, so looking at asset turnover, which is how many dollars of sales per dollar of assets, is a huge metric. You can see it in the slides that we didn't cover, but that's the game. So I think you begin by some education, and then the next level will go a little deeper into, look, here's how we evaluate ROI at our company. If you're doing acquisitions, I'm sure you guys have models that if your people needed to understand it, you could say, look, this is the way we do it at Bergey's. We look at this. This is our required rate of return. Here's our payback. Here's how much leverage we're willing to take on. So you can go deeper. So when a manager wants to come in on a new CapEx project, they should be prepared. Again, we're working on this now with the managers and the CFO of this business to make a proposal to the board for their capital project. Here's the proposal, which is a written strategy type document, and here's all the math that backs up why we're doing it, what the return on invested capital is, all that. Eventually, you want your managers to be able to walk in and make those proposals.
Yeah, you talk, Carmen, about a lifestyle business. A lifestyle business is doing this, right? We're over here. And like one of our clients currently is a very profitable business, moving from 4th to 5th generation. And for 4 generations, they've taken it all out. Not all of it, but most of it. But now their industry is changing, and they're not going to be able to take it all out, or they're going to go out of business. And so they don't have the, I would call it the financial literacy and the financial discipline. That means they don't have the kind of internal leadership like I think Kevin is bringing to CHL and Budnick is bringing to Bergey's. And then you also need a board to help you with this, because most of us who are shareholders, we're not as smart as Mario. But we need to be, right? We need to bring that kind of disciplined thinking to the way we allocate our capital. So, many family businesses are lifestyle businesses. They're not very disciplined. And this is where we live. So this is why this is a very important presentation today.
Yeah, Mario, on your capital allocation model, that mechanics slide you showed, 1 and 2, do you typically look at that like annually? Like, is that at end of the fiscal year where you go through this exercise? Or is that something you would look at like on a quarterly, like trailing?
Yeah, it's more, each company's a little bit different, but I think it's an annual look, because it's not perfect, right? We're sort of saying, look, here's what, I'll give an example of why we recently used it. We're contemplating a bigger capital project. Okay, well, what's our forecast say? Company already has a forecast, do all that normal stuff, operating plan. Okay, let's take that and now let's turn that into an allocation of the profits, and how much are we stretching to do this new project? So Henry calls this the meta-analysis, like the company level analysis of whether this new initiative makes sense financially. So we took what we know that exists, their debt commitments and all this other kind of stuff, and said, okay, well, if we put in a big acquisition, or we put in, okay, what does it do? So it's a tool. So we have a basic tool, because good portions of this are, you kind of know. You know what you owe the bank, you know what your leases are, whatever. And if you have shareholder redemptions. So there's certain things that are committed, and then you can use it then to say, okay, well, how big of a stretch is this new thing we're going to do? So to me, it's like an annual exercise. Then you review it once the year's over, and then during the year, you use it as a tool.
It sounds like something you ought to do at a shareholder meeting. And there often isn't that kind of discipline. And actually, Mario's hasn't had time to show you some of the other tools. He's developed some nice tools here that I understand the result and I understand why it's important, but I don't understand all the spreadsheet moves that are being made. And you don't either as a shareholder, but you got to understand that first slide that you talked about it's pretty simple. But the analysis that ties it into cash flow, which Mario is very good at. I mean, I haven't seen anybody else do this kind of sophisticated capital analysis that Mario is doing. Maybe out there, but I haven't seen it.
It's the 11th commandment, right?
Pardon?
11th commandment, thou shalt have cash flow.
Well, that's what he brings it around to. And so the board that we're both on, I happen to chair it temporarily. You know, we had a capital call, you know, like we want to spend this money. And the president and the CFO weren't prepared. And so we said, no, we're not going to do that. Go back and do it. And now it's coming through. It will be approved. I'm pretty sure, you know, well, actually we did approve it. But it gives management, the board, and shareholders a sense of security. Right, Mary? I mean, that's what you want.
Well, yeah.
It's
I mean,
never perfect. You're always, you know.
To Brandon's question, to me the biggest issue here, and again, I'll amplify this for other times when I do it, but because you know, this is a big part of it, which is what you mentioned about running the business like a real business. Forget the lifestyle thing. If you really want to be serious about having as many options and creating as much value, you start here by getting all the junk out of the business. You know, everybody's got gas cards and all the craziness that at least I can tell you I've seen many times. In lifestyle businesses, they're doing well, but there never seems to be any income. And I mean, I can see them a mile away. So you have to start there. But you know, the biggest thing though is that if you can have this as a regular part of your diet in terms of your discussions, that this matters, it really matters. And you have to, at the end of the year, you should never have any shareholder meeting that you don't say, okay, this is what we made and I want to know where it went. Like, I want to know where it's at. What do we do with it? That should be at every shareholder meeting, board meeting. Okay, what the heck did we do with the money we made? And is there reasons for it? And if you can't do that, and a lot of companies can't, just kind of gets lost. You know, in the cash flow statement, yeah, some's in inventory and yeah, we got to do better with our inventory, whatever. Like if it's not intentional and there aren't disciplines around all of those categories, the money's easily lost because most people are focused on making money, not what to do with it. So, but I think having it as a regular diet of your discussions and then bringing that sort of like shareholder thinking down to your managers so that they understand that it's not only about this, that it's about what we do with new proposals and how we evaluate them so they begin to understand the way these things interact, and then actually showing them what you need to do to present a proposal. Like what are the ingredients of a proposal if you want to buy a new machine or you want, like, this is what you can train people to do that. Part of it is a written document that is more of a strategy thing, like here's why we need to do it, here's the reasons, and then you have your financial people interact with that and say, okay, we're going to run the ROIs on that. Again, I'm pointing, because if you do you did 3 acquisitions or 4 last year, you guys have a model, right? They know what they're doing, and they have a model, and I'm sure they don't buy everything they look at.
And they have a board that really makes sure that there is disciplined review of this. So you need disciplined review at all 3 levels. And many family businesses don't have outside boards with that kind of competence.
But the start of it is that it should be a regular diet of your, as an owner, your discussion about what you're doing at your business, along with how to make a profit.
Other question? Keith, go.
Okay, go again. All of my asset allocations in the past couple of years have been all on maintenance, and they've all been surprises. Surprise, you need new roofs. Surprise, you need new press. Surprise, you need data centers. It's just millions and millions of dollars going out, and they always seem to be surprises. So I'm trying to understand how many years forward should I understand, okay, these are my assets, and this is the maintenance of them.
Yeah. Look, I don't think there's a standard way to do it other than look at your history and say, okay, what has this number tracked, you know, in the last 5 years or 7 years as an indicator?
If you buy a building, you say, okay, I need I'll need a new roof in 10 years.
Right.
Should I know in 10 years I'm gonna have a, like?
Well, 10 years is pretty far out, but you can plan that long if you want. It's pretty far out to predict. But, what I would say is that most people, when they look at it, will say, look, there's a certain amount of wear and tear. Like, I'll use Kreischer Miller as an example. Again, our big spend is IT. With 240 people, we got to make sure these things, and they're loaded with $1 gazillion of software, right? And so that's a lot of money for us. So there's always an ask. We do a capital budget each year. This is what we need, and the list is like a mile long. So then we filter through that, and what we don't agree to goes into the parking lot for next year. So then that might move higher in the list next year, and then more things get added, so we just keep filtering. It never disappears. It's what we may not agree to do everything all at once because, I'm not saying that you should invest in assets in a willy-nilly way. You got to be efficient, right? You want to get them utilized. By the way, the most profitable businesses that I see, I'll use manufacturers as an example, are not gung-ho on buying the latest brand new equipment every year. They are like masters at continually they spend more money in maintenance and refurbishing and reusing stuff to get the useful life of it. I think of two companies in particular that are incredibly profitable because they're really thoughtful. If you come into these companies with a proposal to buy a $250,000 lathe, you better have your act together because it's going to be an argument and a fight to allocate that much capital to it. And I say a fight, it's going to be a serious debate. So it's not like an easy process. You really got to prove the economics of why it's worth it. Because if the economics say, well, it's just nicer and we can do a little bit more stuff, yeah, but maybe it's incremental and we already have a sunk cost in this existing machine, it's going to be an argument. And the companies who are the most profitable don't just don't just write checks all the time for every new equipment. It's got to make really clear financial sense in order to do it. And if it doesn't, they don't do it.
Other comments, questions? Well, I just want to thank Mario for, I think Mario is a good advisor, but he's also a good teacher. And I think Mario has a way of making this, of presenting it in a way that even I can understand it. I mean, you wouldn't want me doing your accounting. And so, Mario, thank you for the
Glad to
work
be here.
you do for us and all of our members. And I would just like to note that being a shareholder is a serious deal. I mean, it really is your most important role, I think, in this. It's not that being a good manager is not important, but this is the really big work. He who makes the rules, he who owns the gold makes the rules, right? And controlling capital allocation is very, very important. So thank you very much for coming, and Sally, let's make it.
Thank you.